with Newsfeed. Good to have you along with us. Well, of course, the breaking news coming out of the Reserve Bank, the Monetary Policy Committee hiking interest rates by 25 basis points from 3.75% to 4%. Widely expected. Our business editor, Xolani Mbandra, is with us. Tertia Jacobs is an economist at Investec. She joins us now. Tertia, good afternoon to you. Look, this was a decision that was widely expected. No surprises from this Monetary Policy Committee.
Yes, Stephen. This time around, we all got it right. And I think the drivers were obviously what happened internationally.
Tertia, what happened internationally? I'm sure you're referring to most central banks in Central North America, countries like New Zealand, countries in Eastern Europe, also going through this normalization cycle due to inflation. Is this what we're going to see most of this year when it comes to interest rates normalization, with countries such as Brazil actually adding some 800 basis points, if I'm not mistaken, to normalize inflation, as we've heard as well from the US yesterday that they expect to increase their interest rates in March?
Hi, Xolani. Yes, I think we touched on all the key points. I think the difference between South Africa and other emerging markets last year were that many of those countries like Brazil that you referred to, Russia, to some extent Mexico, and then Turkey is on its own, actually witnessed an acceleration in inflation much earlier on. South Africa's headline inflation only started to accelerate towards the end of the year and driven mainly by the increase in the fuel price. So that actually allowed the Reserve Bank to keep interest rates at very low levels to provide more support to the economy last year. But we have reached a point now, with November's December's inflation rate rising to 5.9%, which is at the upper end of the Reserve Bank's target range, that requires more action from the Reserve Bank. So we saw the first rate hike as 25 basis points in November, followed by today's rate hike. So it's mainly the headline inflation rate and very low interest rates relative to the rest of the world and where inflation is that is compelling the Reserve Bank to act.
There was a lot of discussion from the Reserve Bank governor around the importance of anchoring inflation expectations. He said that if we sort of manage this properly, we'll have lower interest rates for longer. What does he mean about anchoring inflation expectations? Why is that so important to the market right now?
Stephen, that is one of the most important drivers of inflation, because inflation expectations is what could propagate inflation. Now, for example, with headline inflation running at 5.9%, the key dynamic is then whether market participants expect inflation to settle at 6% going forward, which means that they would start raising their prices by that amount, and that is how inflation then sits at 6% going forward. So when the Reserve Bank tries to anchor inflation expectations, in South Africa's case, to keep it at a 4.5%, and the economic participants and the markets believe that inflation could stay over the medium term at 4.5% and adjust their behavior accordingly. It means that the Reserve Bank has to take less action, in other words, tighten interest rates by less. So it becomes then a self-fulfilling prophecy.
Okay, so in other words, if you manage the expectations, if you manage what people are going to expect, you then have a lot more space to actually keep interest rates lower. I think I get it now.
Absolutely, absolutely.
Tertia, the Reserve Bank governor seems to believe that the MPC decisions of the interest rate hike of November and this particular month have been measured. What are your views? Because many other people would think that they are not the right decisions. They fired the trigger way too quickly for the circumstances that South Africa is in at this present moment.
So, Xolani, that is actually a very good question. You know what happened before 2014, when inflation was relatively higher, we still came from like a boom-bust cycle. So that basically meant that, say, inflation started to accelerate, the Reserve Bank would hike rates very aggressively. So you had like a 50-50-50 in a very short period of time. We have seen since 2014 what a gradual rate hiking cycle means. It basically means smaller hikes, smaller incremental hikes drawn out over a longer term period. So you don't get that kind of demand shock than when you hike rates very aggressively. So to give you an idea, going into this meeting and especially last night's FOMC meeting, the markets were wondering if the FOMC, including the Reserve Bank, could hike rates by 50 basis points, right? Because of an expected upward revision to its inflation forecast, because the Fed is getting more hawkish, as they indicated last night. So the Reserve Bank is actually then sticking to this gradual, measured rate hiking cycle, which will allow people with credit exposure, and the impact will not be as harsh going forward. So it does allow for some planning, for some management, for some adjustment.
Within all of this, Tertia, and I mean, we all know it, we all feel it, the cost of living is going up and up and up. When the Reserve Bank governor starts to talk about inflation, we know currently 5.9%. Now, sure, maybe historically that's not very high for South Africa. Coming out of the pandemic, though, it's high. Food price inflation in particular, electricity in particular. All of this is putting pressure on ordinary people. I mean, sometimes you can get a loaf of bread for just under 10 Rand. If you go to the right supermarket on the right day, you'll have to slice it yourself. But a lot of the time, you just can't afford the electricity to toast it.
So, Stephen, that is then where this whole dynamic comes in. At the moment, we've got supply-side-driven inflation coming from, especially the fuel price. The international oil price is now sitting at nearly $90 per barrel. The Rand plays a very important role. We're likely to see another round of substantial electricity tariff increases in the middle of the year. And then, of course, food price inflation. It's not accelerating, but it is relatively high. So that is not something that you can fix with weaker demand, right? Because it's supply-side issues. But where the Reserve Bank is coming in, it is sending out a signal to contain inflation expectations. And then the other point as well is, and this is where the international side is coming in, our repo rate, our prime rate, is relatively low. It is, the repo rate is below inflation, so it means we have negative interest rates. And that can render the Rand very vulnerable in the international context with higher interest rates, where capital flows are very sensitive to what the Fed is doing. And of course, as always, the Reserve Bank's credibility is very important. So it ties then in. Interest rates cannot fix supply-side pressures. If inflation is contained, then this rate hiking cycle will be gradual and normal, and gradual and slow.
Tertia, global economic growth is now being forecast to be at 4.4%, lower than before. Coming back to South Africa, we are looking at a forecast of 5.2% before, and now it's sitting at 4.8% for 2021. Looking at the growth forecast for this year, I'm particularly never moved by these forecasts. But looking at the forecast for this year at 1.7%, are we punching below our weight? Is this too pessimistic of us, or should we be looking at other measures to actually make forecasts more realistic?
Kalani, I understand the dynamics, what you're referring to other measures, but the key issues for South Africa is, at a growth rate of below 2%, the economy cannot grow and create enough jobs, right? So it comes back to what's happening to the supply side of the economy. Like Stephen pointed out in the intro, last year we had 51 days of load shedding compared to 37 days. This year, there's a high likelihood that we can see another, regular electricity outages. So the electricity side needs to be fixed. We need to get data spectrum auctions so that your data prices can come down. So these are all dynamics that feed into the economy that is being very challenged at the moment. And in that way, when the supply side of the economy becomes stronger, that can allow firmer growth. So yes, I think these are the key dynamics. You know, our potential GDP growth rate with this type of electricity constraint is around about 1%. And that basically means when your economy grows significantly faster than that, you know, the inflationary pressures can actually escalate faster. So there are numerous challenges that we need to address. So a lot of it comes back to the reform and economic reform agenda of President Ramaphosa, that there's more urgency attached to it so that this economy can start getting more vibrant, because that is a big lacking factor at the moment.
Tertia Jacobs, Treasury economist at Investec, thank you very much indeed for your time. Do appreciate it this afternoon on Newsfeed.